In order to trade profitably, we do not need to seek the services of a fortune teller or psychic, buy a fortune-telling ball, the future, or some other useless thing. All we need is a little knowledge, a lot of practice, and a little luck. Yes, you didn't think so. For profitable trading, you need a minimum of knowledge. For example, understanding levels and knowledge of reversal patterns, and most importantly, the logic of their formation. If you want to get the most out of this video, you definitely need to take a piece of paper and a pen and take notes on all the information that I've prepared for you. Reversal patterns, the logic of their formation. There are a huge number of different patterns that are successfully used in trading. Patterns are divided into two types. 1. Candlestick patterns. 2. Graphic patterns. Both of these types are closely related to each other, as the formed graphical model is a pattern consisting of 1 or 2 candles on a higher time frame. Pattern number 1. Every pattern has 2 sides. In classical technical analysis, they are called the left and right legs. The left leg always consists of 3 parts: impulse, correction, impulse. The right leg should always go beyond the level of the knee of the left leg. No matter how funny it may sound, the left leg, right leg, body, head, and shoulders, all these parts of the body, are present in trading terminology. Even the ass is there. Well, this is when the trader lost his deposit. In this video, I will show and explain to you examples for sales. Accordingly, for purchases, the situation will be the opposite. If you read the books of famous trading classics, then you will learn that this particular pattern is a correctly formed 1-2-3 pattern, and not the formation that is now passing him off. The end of the first impulse is where the major player begins to accumulate his selling position. This shows us that the price is breaking in the form of candles with large shadows or a series of fading candles turning into a corrective movement. Retail traders perceive this as a reversal attempt and open their positions to sell, placing their stop orders behind the nearest top. A major player knows about this, and in order to fully complete his position, places his pending sell orders above the nearest high. I call this place the first seller's zone for sales and the first buyer's zone for purchases. Some call this a false breakout or 2B pattern. There are many terms, but the meaning is the same. When banks or investment funds have almost filled their position, the price slows down and begins to decline. Before reaching the first low, the price makes a correction, indicating to traders that it is going to continue its upward movement, thereby forcing them to open their buy positions. Guess where they put their stop losses? That's right, for the nearest minimum. And their stops are the gain of the position of a major player in sales. We see this as a breakdown of the structure, which means the full formation of a reversal pattern. Banks and investment funds also limit their losses and place their stop orders for the high. Since there are other large players in the market who will want to take their money, they will try to protect their positions when the price approaches the retest of the pattern. In our case of this flat, knowing this, we open our trades from the boundaries of the internal movement and place stop orders in the place where the big player's stop loss is. And then we just sit and watch your profits grow and rejoice, imagining how you will throw money away, buying yourself cool cars and luxury houses. The main thing is not to wait too long and close the deal on time. Otherwise, dreams will remain dreams. Before we continue, I want to ask you to subscribe to my channel so as not to miss the release of new videos. According to YouTube statistics, 92% of people watch my videos without subscribing to the Pips LI Trade channel, and this greatly upsets me. Your subscription and activity in the form of comments and likes encourages me to create more useful and interesting content for you. Pattern number 2. In technical analysis, it is known as the head and shoulders pattern. The logic behind the formation of the left leg is the same for all patterns. Therefore, I will not repeat it. When traders' stop losses are taken out in the first sales zone, the price also returns back with an impulse, breaking the structure, taking away stop orders, but only from buyers. Next, the major player returns the price to the left shoulder area, which often coincides with 50% of the impulse movement. Entry to the market is carried out from the 50% zone. Stop loss is set behind the high of the pattern. Remember, to stop catching knives in the market, you need to stop seeing every move as a market reversal. All patterns work only from areas of interest. If the pattern is not formed in the area of interest, then this is a trap, and the pattern will not work. Pattern number 3. Does everyone remember the logic behind the formation of the left leg? Then let's continue. After the formation of a trend break, the price does not rise to the left shoulder zone, but rests against the mirror level or the trend break level. If you pay attention, the price is also making a pullback to the area of 50% of the momentum. We cannot predict where we should enter a trade from. Therefore, we need to wait for the minimum to be broken and open a trade at the next correction. An aggressive stop loss is placed beyond the previous high, and a conservative stop loss is placed beyond the level of the left shoulder. Look at some examples on the chart. All pattern number 4. A very aggressive pattern for entry, but it has its own logical explanation and statistical development. It doesn't come up that often, but as an additional tool in your arsenal, it can be used. It is usually formed after the release of important news. A prerequisite is the collection of liquidity. You can watch a video about all the main types of liquidity on my channel. Understanding liquidity is an integral part of profitable trading. I recommend watching. The price breaks the level with an impulse and the movement begins to fade with the accumulation of volume within this impulse. Since liquidity from above has been removed, the price with a high degree of probability will follow the lower liquidity. The pattern is formed without breaking the trend, since there is a large distance to the left knee. But already within the impulse, a 1-2-3 pattern begins to emerge. The market is entered on the second corrective movement. Stop loss also has 2 placement options: conservative for the high of the pattern and aggressive for the high of the first correction. Using bear patterns is suicide for your deposit. After all, this is a reversal pattern, which means it should form in strong zones from which the price is ready to reverse. To do this, you need to use only levels from a higher time frame, and the older the time frame, the stronger the level. This means there is a greater chance that the price respects it. You can also use imbalance, block order, or flow order as zones of interest. But a stronger factor is the removal of liquidity from local market structures. If we speak in simple words and do not go into details of the market context, then the main purpose of the price is manipulation with the subsequent removal of liquidity. You can also find this information and other useful information on my channel. When the price removes significant liquidity, it is highly likely to reverse and begin to remove the opposite liquidity. Knowing this factor is our advantage. After all, someone makes money in the market only when someone else loses, and losses in the market mean removing stop losses, or, more simply put, collecting liquidity. I am sure that this information was useful to you, and you not only listened to it, but also took notes on all types of patterns in order to apply them in your trading. And that's all. Good luck to everyone, and more profitable days.